Your 30 minutes starting now.
Morning. See you again. How's your day going so far?
Good.
Good. Okay. So yeah, let's step right into this. So today, obviously, David and I, here as your employees in the purchasing department of the Sharp Dressed Man, are here with our presentation of what we'd like to do with regards to the loan and deciding on what to do with that. So moving right into the executive summary about what we're going to be discussing for this presentation. Obviously the main problem at hand is do we accept the loan to pay off the shoe vendor purchase of $76,450 to Bickler Shoes, and do we accept the loan of $75,000. And our recommendation is, because of the fact that we discovered that David will discuss very shortly the reason why we did it, we decided the loan was better, and I'll let David discuss why the loan is better.
Alright, so here at Sharp Dressed Man, the purchasing department believes that by taking the cash discount and paying off the invoice early, will gain a cash discount price of $22,093.50. And even though we're going to be taking on a loan, the amount that we save through taking this loan and paying off the invoice early will override the interest rate that we get by taking the loan, provided that we're able to pay the loan back in full next month.
Alright, so we're going to start looking at some key things that we think are important to discuss. And the first thing is explaining the nature and scope of financing. So essentially, when looking at what this term means, it can be defined as the way that a company gets money to fund its business activities. So within our company, we think it's very important that within the scope of financing that we have a lot of cash on hand. Obviously right now that's a problem that we have that's currently existing, and I can go on and I'll discuss later about the problems about not having cash on hand and why it's important to have it. But looking back and getting back on point of the nature and scope of financing and looking at how exactly we can finance, the main way that our business is going to be able to finance in the future, we hope, is by using debts and bonds. That something that we've already thought of doing right now with this debt that we owe to pay off the shoe vendor, and using a loan to pay off that. And if we can use more of those ways to successfully pay them off, that would be a great thing that we can do. And I'm going to let David, throughout this presentation, he'll be discussing about the ways that we can do that, and one of the ways that he's going to talk about that is by explaining the purpose and importance of credit.
Alright, so for the purpose and importance of credit is very, very important to us, because businesses, they borrow money to fund both their short-term and long-term activities. And if they can't do this, there is a big problem. So businesses, they use a form of credit called trade credit, which I'll explain later, and it's also known as business credit. So right now, at Sharp Dressed Man, we believe that a good credit rating is very important for all businesses, because with a good credit rating, businesses can raise money very easily. And the reasons why businesses need to raise money is because if there are opportunities that come up, they need to be able to take advantage of them. For example, right now, we have an opportunity to take a 3% cash discount if we pay our invoice within 10 days. And this is very important to us because it saves us a lot of money. And also some other businesses will find opportunities in mergers and acquisitions to take control of other companies. Now I'd like to move on and ask Mr. Allion to talk about the nature of financial needs.
Alright, thank you, David. So looking at the nature of financial needs and looking at exactly what that means, it can pretty much be described as our financial needs are essentially the debts and obligations that we owe to pay off. And as I've already discussed, we think that a very important thing that we need to have is cash on hand. And there's a lot of reasons for this. And the one that I like the most is the current ratio, which is when you divide all of our current assets divided by the current liabilities, and it produces a number. And the number essentially shows how strong and how good we are at being able to pay off our short-term obligations. If the number is between 1.5 to 2, that's very ideal. Anything less than 1.5, though, means that we have too many debts. And anything over 2 means that our cash on hand is too high, and it means that we have too much of that. We also need to look at working capital and ensure that that's also very strong for the business. And I think getting back to the most important part of this thing is that we need to have cash on hand. But again, we don't want to have too much cash on hand because that's never a good thing either. But right now, the problem for the business, obviously, as we've stated, is that we don't have enough cash, and we need to find a way to improve on this and working on our current ratio to building it higher. And I'm going to let David discuss more on this as he discusses the importance of business credit.
Alright, so when looking at the importance of business credit, we know that businesses borrow from each other time to time because it is a way of buying and selling on account. So when buying and selling on account, businesses do this because they're able to make more sales and purchases compared to what they would have done if they only had cash. Because with a good reputation, a business can buy items from a supplier knowing that this business will pay the supplier within the amount of time that the supplier specifies. As a result of this, sales in the economy generally increase, and we see an increase in business activity, which is a really good thing. We know that businesses need to have a good credit rating because with a good credit rating, suppliers will trust businesses to pay their debts on time. So now I'd like to move on to the sources of business financing. So as we know, we're the corporation of Sharp Dressed Man, or the business chain. So as a business chain, we are most likely incorporated, and thus we have a very good credit rating. With a good credit rating, we can raise money through a various amount of means. So the two ways of raising money or business financing are raising money through debts and bonds. So debts are contracts that businesses can take on by promising to pay back a certain amount of money at a later time in full, and also with an interest amount, so which will also be paid at a later date. So Sharp Dressed Man here can take out a loan from the bank of $75,000 with a 7% interest rate, of which will all be paid back at the end of 2 months. So also there's another method for a corporation like ours to raise money. Because we are a corporation, we can easily sell our shares in a stock market index if we are publicly traded. By doing so, we do not incur an interest rate, but this has a disadvantage because we are not able to maximize our profitability, as doing so would not increase our net income at all. So next, I'd like to move on to the time value of money, which is the next topic I'm going to be talking about. So the time value of money, in simplest terms, is the fact that money now is better than money later. So because of this fact, if we want to have money now or take out a loan which will allow us to have money today, we must pay a greater amount in the future. The bank is expecting a greater amount of money in the future because of the time value of money and because we are obtaining the bank's money to be used now. So in general, annuities are calculated by the net present value and the net future value, meaning that the net present value is the value of the annuity right now, while the net future value is the value of the annuity in the future. And by this rule, as long as the bond interest right now of the bond is not lower than the market interest rate, then the net future value will always be greater. So now I'd like to have my colleague Mr. Allion talk about the factors affecting a business's profit.
Thanks, Dave. So essentially, when we're looking at the factors affecting business profit, the first thing to look at is what exactly is a profit. and essentially that's obviously the revenues, the money earned by the company, subtracted by the expenses, all the money that the company puts out in order to generate those revenues. When looking at the factors that affect this profit, one of the main factors that we think is, and if the debt will result in a profitability that is much greater than the debt that it takes on, that will lead to a greater net income, which leads to a greater profit, obviously. The other thing that we think is really important when looking at this topic is looking at the liquidity of the business. The turnover of merchandise is something that's very important, and if we can convert our current assets to cash through sales very quickly and very easily, that's going to be a way that we can generate business profit. And another thing that I would like to talk about is something that we read during the information that was provided to us was that the economy is slowing down and the business is facing a lot of troubles. Obviously the main reason for why we don't have a lot of cash on hand because we're not making many sales. And we wanted to discuss this now and use this opportunity to discuss ways that we may be able to improve our sales and everything. So we think there are tons of ideas that we can use to implement ways to increase our profitability. Anything from using new technological advancements, as it's always becoming a more and more popular thing, introducing sweepstakes, offers, discounts, sales promotions, anything we want to. Using the way that we were going to be able to decide which ways would be best to use sale promotions, where we were going to think of making questionnaires for our customers online, and if they complete the questionnaires about all that sort of stuff, then they could get discounts to the store and whatnot, and that would be a way that we could generate more sales for the business. And so just in conclusion, we think obviously, as David stated and I've stated, there are multiple reasons for why we believe that taking on the debt and taking on the loan would help the business, because it would generate an increase of actually $2,293.50 as compared if we were to pay off the money to the shoe vendor normally. And we've discussed also many reasons for why we think that having cash on hand and converting cash quickly is very important. And we'd like to thank you for listening to our ideas today. And if you have any questions, feel free to ask us what you'd like.
Yes, I just have one. What if we simply ask our shoe vendor to take whatever we can give them 2 weeks from now and pay the balance whenever we can?
The thing is, if we do not pay our invoice in full, we won't be able to take advantage of our cash discount, which is very important to us. Because by taking that 3% cash discount, if we pay the invoice in 10 days, that's basically an effective annual discount rate of 36%, which is really significant. 3% per month translates to 36% in a year, so that's a huge discount which we really need to take advantage of. If we were to negotiate different terms, we would not be able to take advantage of the cash discount, and we would lose out on a huge opportunity.
Thank you.